The top business stories live from the Sky News City studio. Lawmakers in Washington pass a bill ordering TikTok's Chinese parent to sell its US operations.
The yeas are 352, the nays are 65. One present, 2/3 being in the affirmative. The rules are suspended, the bill is passed.
It's now over to the Senate as concerns mount that the company is a threat to US national security. The UK economy returns to growth in January, raising hopes it's already out of recession. And insurer Direct Line reveals it's rejected a second takeover approach from Belgian rival Ageas. Good afternoon, this is Business Live with me, Ian King. We start this afternoon on Capitol Hill, where this afternoon the US House of Representatives has overwhelmingly approved a bill that would ban TikTok from operating in the United States or force a sale of its US operations. The bill passed by 352 to 65, winning support from Republicans and Democrats alike. That was despite intense lobbying by thousands of the 170 million Americans who use TikTok regularly. Well, joining me now live from Washington is Rebecca Klar, technology policy reporter for The Hill. Rebecca, welcome to you. I guess the big question now is, will this bill make it through Senate?
Right. So I think that the overwhelming support that we saw in the House definitely puts the pressure on the Senate to look at this bill. Already we've seen the leaders of the Senate Intelligence Committee, Marco Rubio and Senator Warner, come out and say that they're going to work towards pushing this version of the bill through the Senate. I think it's yet to be seen exactly if Senate Majority Leader Chuck Schumer would put this bill to a vote. And I don't know if we can expect to see quite as fast of a process as we saw in the House, because that was definitely a bit unusual. The bill got a floor vote less than a week after it was first introduced.
Were you surprised at the bipartisan nature of the support for the bill?
You know, I think what's interesting about this bill is both the bipartisan support as well as the strange bedfellows we saw in terms of the bipartisan opposition. So it really brought together really progressive members on the left, like Alexandria Ocasio-Cortez, with some of the most far-right members on the right, like Marjorie Taylor Greene. So I thought that was a really interesting dynamic in terms of how the support and opposition for this bill broke down. But I think over the past year, we've seen a lot of talk on both sides of the aisle about the national security concerns with TikTok. This really seemed to be an escalation of all that work that they've been building up.
Now, if the bill does make it through Senate, do you think TikTok is going to be able to sell its US operations in just 5 months?
Right. So that's sort of one of the sticking points here, is where supporters of the bill say this isn't an outright TikTok ban because it gives them that 5-month window in order to sell it. But critics, as well as TikTok themselves, say that that's a short time frame. And ByteDance has been pretty steadfast in saying that they're not looking to sell TikTok. So I think ultimately what this would sort of lead to is leaving it up to the courts to decide if the bill as drafted does get around some of those issues we've seen with past attempts to ban TikTok, or if it would say sort of that same fate that we've seen other bills face.
I mean, the former CEO of Activision Blizzard, Bobby Kotick, has said he'd be interested if the business came onto the market. Can you see other potential buyers out there?
I mean, I think TikTok is definitely a really popular app, very lucrative business. I think what it'll really come down to if ByteDance is willing to sell it or sort of call the bluff maybe of lawmakers and see where this, heads to, and also see how courts decide if a ban is constitutional or not.
Now, this is very unpopular with TikTok's American users, thousands of whom we understand have been contacting their representatives. Can you see this having an impact on the US presidential election?
Yeah, I think the election plays a really interesting point here. Obviously, we've seen sort of a flip in terms of what former President Trump has said. He tried to ban TikTok while he was in office, sort of kicking off the initial efforts to do so, and now has come out against this, whereas we've seen President Biden, endorse this bill and say that he would sign it if Congress passes it. But the Biden campaign has also joined TikTok. So I think that's sort of an interesting line where lawmakers are going to have to walk in terms of if they're using it to reach voters and also how they see these national security concerns play out.
Yeah, it's really an interesting point you raise there, because, I mean, Donald Trump, as you say, doesn't want TikTok banned because he thinks it will strengthen Facebook.
Yeah, that's sort of been what he's been casting his recent comments around in terms of what impact this may have on Facebook. Meta, Facebook's parent company, hasn't really said anything to those concerns. Obviously, we've seen a lot of social media companies, including Instagram, Facebook, roll out features over the past few years in order to keep up with TikTok and its short form video content. So I definitely think it'll play an interesting role there.
As a tech specialist, Rebecca, do you believe that there is substance to this notion that TikTok is a threat to US national security?
A lot of the briefings that lawmakers have had are obviously classified about this, and there does seem to be a split. Yesterday, House members were briefed by members of the intelligence community about these risks, and it didn't necessarily seem to sway certain members that were on the fence. We heard a lot of Congress members who are against this bill say that while there may be those risks that are posed, it's more of an industry-wide issue as opposed to targeting a specific company like TikTok or its owner ByteDance, and would maybe prefer to see a comprehensive data privacy bill, which the U.S. still doesn't have. But at the same time, there's definitely lawmakers who have left these briefings saying that this does pose an imminent threat. So I think that's something that the Senate will surely be considering as this heads there.
Now, if ByteDance is forced to sell or close TikTok in the US, could you see the European Union going down the same road?
Yeah, I think definitely looking at what the EU would do is interesting. I do think, the EU has led on a lot of tech regulations that the US hasn't done in terms of things like privacy legislation, competition law. So, there may be thinking that there's already sort of that set of regulations in place to limit some of these risks in terms of regulations that they've put on massive tech companies, including recently ByteDance. So I definitely think it's something to watch to see if the U.S. leads the way here or, if other countries take different approaches.
OK, Rebecca, I have to leave it there. Great to talk to you this afternoon. Thanks very much indeed.
Thank you.
Some other business news for you now. And the UK economy returned to growth in January, raising hopes that the country is already out of recession. The Office for National Statistics said that UK GDP rose by 0.2% between December and January. That followed a fall of 0.1% between November and December last year. The biggest contributor to GDP growth was the services sector, where output grew by 0.2%. Production output fell by 2.2% during the month, despite growth in manufacturing output, while the construction sector enjoyed growth of 1.1% during the month. Well, speaking to me a little earlier, Deutsche Bank's UK economist Sanjay Raja said it looks very likely the UK is moving out of recession.
If you look at the survey data that's surrounding us, PMI data, particularly on the services side, which we know is the growth engine of the UK economy, 80% of what we produce is services. That's been running very strongly. Look at the sentiment data. The Lloyd's Business Barometer has been very, very strong, well above its long-run average. Sentiment data is improving on the household side. We had a little bit of a dip on the consumer confidence side in Feb, but that uptrend is certainly still there.
The insurer Direct Line has revealed it has received and rejected a second takeover approach from the Belgian multinational Ageas. Ageas, which 2 weeks ago offered £3.1 billion for Direct Line, said its latest approach valued the company at £3.17 billion. In response, Direct Line said the board considered the latest proposal with its advisers and continues to believe it is uncertain, unattractive and that it significantly undervalues Direct Line Group and its future prospects, while also being highly opportunistic in nature. Well, Direct Line shares have actually fallen this afternoon on that news, currently changing hands at £2.16p a share. The latest Ageas offer values it at £2.37p a share. And shares of Balfour Beatty have surged by more than 9% today after the Infrastructure and Construction Services Group predicted profits growth this year in its core business. The company, which employs 30,000 people worldwide, including 12,000 here in the UK, was reporting an underlying operating profit of £236 million for 2023. That was up 2% on 2022. Leo Quinn, the chief executive, predicted faster than expected activity in the UK power sector and a recovery in US orders. As a sign of its confidence, the company has raised its dividend by 10% and launched a new share buyback programme. Now, one of the UK's leading backers of breakthrough science and innovation companies said today it was still seeing plenty of investment opportunities despite a tough 2023. IP Group, which was originally founded to help the University of Oxford's chemistry department commercialise its intellectual property, was reporting a 14% fall in its net asset value to £1.2 billion for the year. Well, joining me now, I'm pleased to say, is Greg Smith. He's chief executive of IP Group. Greg, welcome to you. A quick word on the results. I mean, you wrote down the value of some of your assets quite significantly. Was there an overriding theme, or is it lots of individual factors?
Yeah, I think the key message is from the results were really around the fact that we've focused the business down and we're financially strong. But actually, the thing that I'm really excited about is that we think this could be a game-changing year for IP Group. We're playing on our winning ground. We invest in life sciences, we invest in clean tech, we invest in the digital revolution, AI and cybersecurity. And those are areas that are of critical importance to human society. And so the milestones and the breakthroughs that we can see coming up in the next sort of 12, 18 months give me great confidence that this could be a really game-changing year for IP Group, which is great.
And you do make the point in the statement, you see less downward pressure on valuations this year.
Yeah, that's fair. I think the green shoots appear to be coming through.
Now, you mentioned the three areas you invest in, deep tech, clean tech and life sciences. Where are the greatest opportunities going to emerge this year?
Yeah, I think across all three we see great opportunities. I mean, one of the businesses I'm most excited about, we have a life sciences business which is backing and developing a new potential treatment for autoimmune disease that can not only cure the symptoms of autoimmune disease, but amazingly reverse some of the bone damage seen in things like rheumatoid arthritis. And why is that important? Well, there's more than 100 million people globally that suffer with those diseases. I know from personal experience from my own grandma that it leads to pain and misery. And so if we can successfully get this company through, you can imagine the impact that it has on those sufferers, on society as a whole, but also creates a huge opportunity for value creation in our portfolio.
At which stage in a startup's life cycle do you most commonly like to invest?
Well, we are technology investors. We think that our particular edge is in understanding and pricing technology risk. And so we can start very early, but we have the capital to support those businesses through. And interestingly, on the subject of capital, I think the conditions feel right at the moment for many others to join. You talked earlier about the huge opportunities that we're seeing. I think there's a great opportunity now for other investors to join us, to partner with us, to co-invest alongside us and really take advantage of that opportunity that we're seeing.
Well, that's a thought. It's very much of the moment because the government obviously is very keen to get pension funds to invest in young companies and growth companies. You're not worried about being crowded out by some of these guys?
Well, I think the government talks quite a lot about the concept of the UK being a science superpower. And I think that the UK can have the confidence to be a science superpower, but we need three ingredients, the three C's. We need capital, we need long-term capital, that's people like us and IP Group, but others joining us. We need conditions, and the conditions are the many measures that the government, the regulators, the stock exchange are trying to move through to make the UK the best place to be able to start, to grow, to scale and to keep these leading technology companies. And we also need to be consumers of that technology. And so it's really encouraging to see Genomics England working with one of our leading businesses, Oxford Nanopore, in order to improve cancer diagnostics. And that's a big gateway into the personalised medicine world. So there's a huge opportunity out there, and that's why I'm really confident that this could be a really game-changing year for us.
But do pension funds necessarily have the skill set to invest in this area? I mean, you guys have been doing it for more than 20 years. You know what you're doing. There are lots of VCs that know what they're doing. This is a whole new game for pension funds.
Yeah, I think not for all. We're very lucky to have some of the pioneering pension funds in the space who are invested in us, investing with us, the likes of Railpen, the likes of Phoenix Group, M&G. But we think that as I said, I think the opportunity is greater than we have capital to provide. And so really the conditions are right now. And what we really need is for others to follow their lead and to work with us, to partner with us and to invest with us and use the expertise that we've been building over the last 20 years in order to bring that to reality. Now,
the IPO market was pretty subdued last year. Do you see that picking up this year? Is that going to enable you to exit some investments this year?
Exits are definitely a focus of ours. The IPO market appears to be warming up. I mean, most of the businesses that we are building and developing have products and services that could lead to trade sale, and that will enable us to deliver shareholder returns. But we're confident that the conditions are starting to improve, and I think it could be a really transformational year for us this year.
All right, upbeat note on which to end. Greg, busy day for your results day. We do appreciate you sparing the time to chat. Thank you.
Thank you.
Still to come here on Business Live, we'll have a look at how the markets have done this Wednesday afternoon. Stay with us.
Sky News.
From the Sky News Centre at 7.
Now that you're up to date, we can go into a bit more detail.
Things can change incredibly quickly.
Taken by surprise.
Have you ever known a moment like this in British politics before? Yes. Cheers.
We'll start with breaking news.
Let's get the latest on the ground.
So, by the end, we'll hopefully all understand what's going on in the world just that little better.
I'm Martha Kellner and I'm Sky's US correspondent based here in Los Angeles. We aim to be the best and the most trusted place for news.
I'm Martin Brunt and I'm Sky's crime correspondent. We take you to the heart of the stories that shape our world.
I'm Helen Ann Smith. I'm Sky's Asia correspondent and I'm based here in Beijing.
We help you understand the world with us. I'm Neville Lazarus and I'm Sky's reporter based in Delhi.
Traveling is not just about the destination. It's also about how you get there. Fly Emirates, fly better. Fly Emirates, fly better. Thank you.
European stocks have finished largely in positive territory this afternoon. Here's how the main continental European indices finished. Only the DAX in Germany in negative territory. The big talking point this today has been Inditex. That's the parent of Zara, the fashion retailer, of course, up 7.5% in Madrid to an all-time high. That's on better than expected sales figures. Here in London, well, the FTSE 100 is also finishing the session in positive territory. Can't show you what it is there, actually. There we go. It's up a third of 1% right now. Mixed trade. The mining heavyweights have lent support there. So the FTSE finishing up 24 points to the good. Well, the mining and commodity trading house, Glencore, has chipped in with 10 of those on its own. That's on the back of support from one of the brokers today. Meanwhile, Flutter Entertainment, the owner, of course, of Paddy Power and Betfair, is up 1.75% for similar reasons. Outside the FTSE 100, Balfour Beatty, which I mentioned a little earlier, that's the leading mid-cap gainer today on its results. It's finished up just over 9%. Meanwhile, the iron ore producer Farrell, which you mentioned earlier in the week. That's off 3% after it postponed publication of its results. On Wall Street, it's been a mixed opening. The S&P 500 and the Nasdaq have opened to the downside, while the Dow Jones and the Russell 2000 have opened higher. Talking points today include the discount retailer Dollar Tree. That's off 14% on a trading update in which it announced a major store closure programme. Meanwhile, GE Healthcare is currently 2.75% lower as its former parent, GE, of course, announced plans to reduce its stake. On the foreign exchange markets, it's actually pretty quiet right now. Sterling more or less unchanged against the US dollar. It's off slightly against the euro. You can't see it on the screen there, but I can tell you the sterling is currently about 1/6 of 1% lower against the euro. Good day for the euro just now. It's also higher against the dollar just now. As for the oil price, well, that has hit its highest level for a week on news of an unexpected drop in US gasoline stockpiles. Having a few problems with the graphics this afternoon. Anyway, I can tell you that Brent crude, last I looked, was around $83 a barrel, so that's up about 1.75% on the session. Well, joining me this afternoon is Patrick Farrell. He's Chief Investment Officer at Charles Stanley. Patrick, great to see you as ever. What did you make of the GDP numbers? I mean, if anything, they were sort of pleasant surprise almost.
Well, it was actually quite a pleasant surprise to actually see some of the consumer-facing services sector really start to come back in January. I do think that that's something that we need to watch quite closely, but also the construction sector. Now, the construction sector has been quite weak for the last 6 months, but it was very good to actually see some activity starting to come through in terms of those numbers. And I do think that the market interest rates that have actually sort of come off a little bit, particularly towards or in November and December last year, have actually provided just a lot of relief for mortgage holders that are in the midst of resetting their mortgage rates, but also I think for the construction sector, mortgage rates have actually come down off the back of it. So hopefully we actually see some of that activity continue, and I think it'll be good for the UK economy if we do start to see that bounce off the bottom.
Yeah, very interesting. I mean, very upbeat statement from Balfour Beatty today. We had Costain on the programme this time yesterday, also pretty confident. Elsewhere, Patrick, Morrison's no longer quoted, of course, but they've caught your eye today.
Well, I mean, as we've sort of spoken about before, Ian, any company that's got so much debt is going to come under a lot of pressure with the higher interest rates that we've been seeing, and just the ability to service that interest cost is always going to be a problem. But then when I look at sort of Morrison's, it's in a very competitive sector, and the whole sort of consumer staples of retailing and food, it's very, very difficult in terms of how that's going to continue to cope, I think, with the competition, but also with the higher costs that they need to deal with, because we're still in an environment where, a lot of these companies that operate on very, very tight margins have to really deal with the cost inflation that they've been dealing with for the last sort of 2 years now, and it does become very, very difficult. So, look, I think it's a long, hard road for them. From a private equity perspective, it's going to be pretty difficult for them to offload at this particular point. So I think they just have to sort of really settle down and get through this difficult period.
Yeah, absolutely. Now, talking of difficult periods, we heard today from Metro Bank, a company which is, about the last 5 years, has been a difficult period for it.
I think they tried to come out with some innovative sort of techniques, let's put it that way, but they run a very high cost sort of line, and I think that's really come home to bite them. Obviously, the rescue package that came through in October was a lifeline that they absolutely needed. And I think as we sort of spoke about the market rates falling in November and December, I think that helped to improve sentiment, and it probably helped to improve some of the sort of risks that they've got on the balance sheet with some of the mortgages that they do have. But I do note, in terms of some of those results, that A, their deposits have gone down, and 2, their loan provisions have gone up. So it is still a worrying time for them, and I think that the only avenue that they've got, as they've announced, is that they have to continue to cut costs. So it's going to be a difficult time, and I think that they do have a confidence problem, but at the same time, they're trying to work through it. So let's see how that pans out.
Yeah, I mean, it's very hard for these challenger banks. I mean, we've just seen that last week, Virgin Money agreeing to a takeover by Nationwide. It's very, very difficult to break into this market.
It's difficult to break into the market, and it's difficult to be able to maintain some of the momentum that they need to, because all you need is a problem with being able to access some of the wholesale markets in terms of funds. And if you actually see some of your deposits declining, then that's a source of capital that they can't on-lend. So they have to manage that very, very closely. And unfortunately, they end up going down the credit spectrum in terms of the mortgages that they secure.
Indeed.
So
Patrick,
it is a tough market.
It is. Got to leave it there, Patrick. Great to see you as ever. Thanks for joining me.
Thanks very much,
That's
Ian.
it
All the best.
from me. I'm not in tomorrow. I'm going to Cheltenham. The programme's off air in my absence. I'll be back with you on Friday at 11:30. Hope to see you then. Cheerio.